My jacket. Tommy Hilfiger bomber jacket.
It doesn't look comfortable here. Is that comfortable?
Yeah, it's got to have really thin arms. It doesn't look comfortable for big muscular fellows like you.
Hulk Hogan could never pull that off.
No, brother. He could not. Right?
Oh, it's so good.
Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. Today, we are asking a very important question. Is this the least affordable housing market ever? And what does that mean for real estate investors? I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow. He's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
You like the extra good?
You threw me off there. I didn't know where we were going there.
Where we're going. Now I'm a little confused. GC, do we have a tradition that we usually start the show with by any chance?
We do. It's called Ye Rolled Call.
All right, we got the our usual leadoff hitter batting first today.
John Henning.
The MVP batting second.
Mr. Lee Bishop.
Everybody knows Lee. We got Le Monsieur.
Roger Fonseca.
Roger Fonseca from we got LinkedIn Lowry in the house.
All right, Ed Lowry.
Ed Lowry. Who else we got in here? We've got, the early bird checking in.
Dean Curry.
Dean Curry. We got the KOB, King of the Beach.
Christopher Lee.
Christopher Lee. We got the Ringmaster.
Andrew Barnhill.
Andrew Barnhill. We've got the Maven from the mountains of Denver.
Ms. Leslie
I
Wilson.
wonder if I should say mountains of Denver, because it's really Denver, and then there's the mountains right next to it.
I think you need to separate and give them their due respect.
Maven from the mountains. The mountain.
But are you going for alliteration?
I'm just gonna go for it. All right, who else we got in here? We got the
Billy Green. Right on time.
Oh, good to have you, Billy Green. We got Belinda Baldwin from Dallas, Texas.
All right, Belinda.
Belinda, good
Is that a new name? I was gonna read your cues. I didn't know. Belinda, welcome to the party.
The show. We're not sure if you're new or not. Let us know. We got the mystery man in the house.
Mr. Denny Davies.
Mr. Denny Davies.
Happy Thanksgiving, bud.
Thanksgiving. We got Laura Colby wishing us a good morning from
Washington State, of course.
Of course. Alex Diaz from Tampa.
All right, Alex.
Welcome back. Good to have you back in here. Who else we got in here? I've got the chat way too small here. Oh, the Man of Steel.
Vincent Barberite.
Holla. Good to have you. Holla back.
I believe that's pronounced Ola.
Is that? Yeah, I guess that's Ola. If it had the upside down
Cool.
exclamation point, I would know it's Ola. Instead, I pronounce it in the English style.
I'll help you with Spanish. Don't worry.
Muchas gracias. We got all-man BJ McKay in the house.
All right.
All dude. Right. He says, hello, gobblers.
All right, BJ.
Linda Evans checking in.
All right, Linda. Great to see you.
Good to have you back. Justine Herrera from Burbank,
Colorado. All right.
Good to have you in here. GC, speaking of we got breaking news, GC. What's breaking out there in the world?
I love how you set this up. We're like, oh yeah, and then you do the beep 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 beep. You're doing a great job. Even you're surprising yourself, right?
Yeah.
Well, we've got some awesome breaking news to share with you guys. Number one, just a quick save the date. We have the Q4 Q1 Jacksonville real estate market update coming up on Tuesday, December 9th. Mm-hmm. So just make sure you mark your calendars. If you want to bring a friend, this is the quarterly show that I do the most research for. We come prepared to share all things Jacksonville and beyond Jacksonville real estate investing, relating it to the economy, relating it to what you're thinking, relating it to how investment decisions can and should be made. So it's one that you want to mark your calendars for. Tuesday, December 9th, we will be bringing it for the quarterly market update.
Any teasers about what you are? So this quarterly market update, always the most attended show is the one we put the most effort in. You generally have some kind of like dialed in point of view of what's going on in the world. I know you've started researching already, GC.
I have.
Any teasers might be about?
Honestly, the show that we're talking about today is interesting to me. I'm in this concept generation phase, so I got 3 or 4 different angles that I think are important to share, but I'm in the zone of content or formalizing and make it simple and easy to understand. So I don't have much of a defined teaser for you other than you're gonna want to be there.
GC is in the CG concept generation zone, baby.
There you go.
I like it. All right, cool. I'm excited about that. I'm excited about today's show, by the way, based on this stuff. But also, we got other breaking news, GC.
We do.
News in one day?
How about that? We can handle it. We're prepared for this.
God, it's so breaking.
So us here at JWB, we're blessed to win an award, one of the awards that means the absolute most to us. In fact, it probably means the most to us. It is the Top Workplaces Award. And we have won this award 11 times now. Every time it matters so much to us, but we were just voted as a top workplace in Jacksonville for the year 2026. Super excited for our entire team to share this, this award. And what this does, it validates all of the wonderful people we have here behind the scenes working for you at JWB, but it also is a huge talent attractor for us, because if you're a talented person who wants to work in a top workplace in Jacksonville, the first place you should go is to look at where the top workplaces are. So it's an exciting thing to win, and it's exciting because more talent to come.
You've taught me a lot about the importance of these awards, right? Like, it's easy for me to brush it off as like, this is a popularity contest, like this is something you do. You guys put a lot of effort into, I mean, obviously doing the things to win the award, but also like, it's important for you to win the award. It's because of that idea of like, it symbolizes to other talent that you want to bring in. Like, it's not just important that you're a great place to work, but you want to continue to attract top talent to make it a better place to work.
Yeah, I used to think of these as sort of like vanity awards too, but you can think of it that way, or you can use this information to make yourself, your workplace that much better and use it to improve, and then also to attract future talent. But this award matters a ton. And it is, it's not just that our team anonymously, everybody is surveyed across Jacksonville, whoever applies is surveyed. And then the top responses allow a winner to be selected. So our entire team is surveyed, and anonymously, they're sharing their opinions on it. The information that they share anonymously helps us improve what we do here. But it has also created other things that we can do to measure our success as a team here. So, we've talked about the NPS score, the Net Promoter Score, and many times teams will do that, companies will do that for the types of, for their clients. Like, how likely is a client to refer a friend or a family member to do business with you? It's very normal in that space. Well, we said, hey, listen, if we want to be a top workplace and continue to win this award for, 8, 9, 10, 11 times, let's do the NPS for ourselves here internally. So we have our own team NPS where we are rated, our teammates rate us, we benchmark ourselves. So it is something that matters. It is one of many, many initiatives that help us retain talent, drive culture, all of those things, and then the output is that we get to win these awards every once in a while.
Do you have a sense of like who else wins these awards? Like, when I think of JWB, a real estate company, like I would expect it to be like Blue Cross Blue Shield or FIS or the other Fortune 500 companies here in Jacksonville. Like, are they usually businesses of your scale? Are they bigger businesses? Like,
you'll have a big companies, like a large employers, it'll be like over 500 employees. So there'll be a category for the top workplaces for the large employers. And then there'll be a medium-sized business. So it'll be 100 to 500 employees. And then there'll be under 100, which would be a small business. So we've been able to win in the small business category. We've been able to win in the medium-sized business category, which I think is pretty cool.
Moving up in weight classes.
We are.
I like that. I like that. Heavy. You're the medium hitter now.
There we are.
Awesome, GC. All right, man. I think this is going to be a really fun show. I don't think we've ever done this before. We kind of challenged each other to be like, hey, why don't we bring each other some data here and pitch the other guy this like idea that we're having based on analyzing historical prices. What can history teach us about affordability in the market? Kicked off by you examining the early 80s and the US affordability. What got you going down this path?
I just think that when people are deciding whether or not this is a good time to buy a home to move into or to invest in a home, the first thing that people talk about is affordability. But we know that affordability is largely driven by interest rates. And so to me, I understand that what affordability is today is largely temporary when you think about what interest rates can and will likely do in the future. So I always look for beyond affordability, is this a good time to buy? Because affordability can change dramatically. It already has changed dramatically over the course of this year because the average interest rate has dropped about a half point. So I'm constantly searching for, ways to understand that this asset either is the right asset to buy, irrespective of affordability, or is not, because that can change. And then that led me to think about other times when we as investors, our country, it has been kind of determined that housing was unaffordable. And I was like, well, let's just say that let's buy into the unaffordable theory here that it is going to be pervasive and be here for forever. And I should probably clarify. I know that it is really tough to afford housing right now. So I don't mean to minimize that housing is unaffordable. It's certainly not what I'm saying. But what I'm saying is it's temporary. And what happened to real estate values after other times that were deemed unaffordable? Did it just not grow at all? So it kind of got me down this path. I think I read an article on it a couple of weeks ago, and I was like, Pops, take a look at this. This is some pretty good stuff. And I think led us to today.
Okay, I like it. I like it. We're going to go back to a period. I think we've kind of like hit on this period a couple of different times, right? But I think you did a slightly deeper dive from a very different lens in this time. Are we in the least affordable market ever? 1982 versus right now. I think the first thing that everybody should know is that we are not investment advisors. Take this stuff as informational purposes only. Do your own due diligence with stuff like that. What are the other key points I need to hit in this disclaimer?
You nailed it.
Okay, tell me what's going on.
Yeah, so went back and looked at 1982. And when we're understanding affordability, we're looking at what was the median home sales price at that time of a home? What was the average mortgage interest rate? What was the average mortgage payment per month? And then how does that relate to the income level? Because, when you're understanding how much of an income level you have and how much of a percentage of your mortgage payment you're making, that's really what people are determining as unaffordable. So going back to 1982, that was the year I was born. I certainly don't remember this. I don't know who remembers this out there, but
I mean, I definitely remember this.
You probably do. You were a wise old man at that time.
I already had 2 Johns.
Right. But I don't know if people were what the relative clamor of unaffordable was at that time, but I would imagine it was loud and strong, and people were saying housing will never go up in value again because it is unaffordable. Now, the reason that it was unaffordable at that time was because of our interest rates at that time. Our average 30-year mortgage interest rate in 1982 was over 16%. So if we look at what housing costs were, the really large interest rate that we have, the mortgage payment per month, and our income, what we understand at that time in 1982, the average American spent about 37% of their income on housing at that time.
$59,000 for a home, average home price of the United States, man.
Crazy, man.
What is it now? Like 400 something?
Well, you should turn to the next slide, Vanna.
We'll go to the next slide. So $59,000, about $60,000 is the median home price for an entry level home in the United States. 16% interest rate. So like we've talked about this before. The fact that we're not in the highest interest rate environment by a mile right now. Average mortgage payment still seems low, but then of course you take it relative to average median household income, 21,000, right? Luckily, wages have gone up some as well. So making up 36.7% of your income spent on mortgages. I've always heard you don't want to be over like 30%, right? It's kind of like what everybody talks about. So go to the next slide.
Yeah, well, let's make one more point here. Income. The household income is so important here. And when we think about how much home values have gone up over the years, what we tend to forget is how much incomes have gone up over the years as well. And so, yeah, let's go to the next slide here. We're going to see, of course, home values have grown tremendously, but we're also going to see that incomes have grown tremendously.
Got it. Drew Barnhill says he bought a house back then and his debt to income ratio was 60%. I had to have 2 roommates to avoid that. So he was like house hacking back then. Dean Curry graduated in 1983. I think he was voted most likely to be the earliest bird. And Ed Lowry was also there in high school. So
super
just letting you know what's going on here with the community. Okay, so 2025, what's going on here?
All right, so we are in a time where Americans are spending a significant amount of our income on housing. Absolutely, that is why we feel like it is unaffordable. But in reality, it's 28% versus 37% back in 1982. Here, our median home sales price for an entry-level home is about $414,000 across the U.S. The average 30-year mortgage interest rate is about 6.25%. that gives us a mortgage payment of about $2,000 per month
Mm-hmm.
for principal and interest. But our incomes, of course, over the years, due to many factors, have gone up substantially. So our average median annual household income in the U.S. is about $87,000. So if you use that to understand, is this unaffordable, and how unaffordable is it compared to other times that were deemed unaffordable?
Yeah.
It is close to that 30% measurement. So that's why we feel like it's unaffordable. This is not the most unaffordable time in history.
Yep.
If we go back to 1982, it was significantly more unaffordable.
It's interesting because I look at these numbers you see, and it's like from 60,000 medium home sales price and a 21,000 medium household income, right? Like it feels like those things have gone up. I wouldn't have known without looking at it, but it feels like, 60 to 400,000 is about 5x. 20 to 89,000 is about 4.5x,
Yes.
right? So that's kind of gone up correspondingly. We talk about inflation and have wages kept up and stuff like that. It feels like if you look at it objectively has generally kept up. The big difference is this mortgage rate, right? Like it's this idea of like 6.26% versus 16% that makes it it's only 8% total, right? But like 8% here is actually 25% of the total
Sure.
piece of the pie, right? So keeping us under that 30% threshold that I think banks like to lend for or whatever, right? Like debt to income ratio. Is that?
Yeah, it's usually 30 to 40% is what you'll be able to get a mortgage for.
Yeah, 30 to 40% is what you get a mortgage for, but right, like a healthy, probably where we got this rule of thumb of like what you should spend on housing. And we are 5% less, right? So like what's like 1/6? What's 5% of like 28%? Somewhere around
5 over 25 is one fifth. So yeah, whatever.
20%.
There you go.
Yeah. 1/5. So significantly more affordable. Why do you think we are so why do you think we're screaming so much about affordability if we are still at this idea that the average household income versus average, like median home price, is still in line with these 30% or below expectations?
Well, it hurts. I mean, we're screaming about affordability because it's hard to afford things, right? Housing's a big component of that. It's not only housing, though. Everything has gone up so significantly over the past 5 years. So that's real. But I think it's important for us to keep this in context because the bigger point that we're trying to understand is, as investors, what does this mean for our investment going forward? There are many talking heads out there that are saying we're so unaffordable right now that home values will never grow again. And so the point of this is not to say, hey, this is unaffordable, or I mean that this is affordable. We are somewhere around 30%. We'd like to be somewhere lower than that for sure.
Yeah.
It is, hey, can this asset still grow knowing the level of unaffordability that we have right now? That's really the question.
Yeah, and I guess true. So that's obviously the question that you're asking here, right? Like my question is, did we just get like super spoiled? I don't know if spoiled is right, but like I guess our expectations have been anchored to this kind of period that feels like an outlier in American history of we've had super low interest rates for a really, really long time. Now interest rates are a little bit higher.
Yeah.
They're not like that much higher that it's like, looking at these like 16% things, right? But like I guess our expectations have been anchored to that period from like 2002 to 2008 when it was really, really easy to buy a home. And now it's just like about average as hard as it's always been, right? Like before before those times, people had to like save up and get there as opposed to just be able to like get there immediately, right?
Help me understand your question a little bit better.
What I'm
Like, why do we feel this way? Like, why?
Yeah, it just feels very emotional, right? Is what I'm saying.
Gotcha.
Like the emotion behind, like if you look at objectively wages and you look at cost of living for affording a home, it seems right in line with everything I've always been told it should be, right? Like about 30% of your income should go to this thing. And yet, we're just kind of like yelling from the rooftop about housing being too expensive. And I would assume that there's some markets where these numbers are off, right? Like we're fortunate that, like maybe middle America and here and these smaller markets, right? But like overall, the data shows that we're right in line with kind of like what we should be spending on shelter.
Yes, you're right about that. I mean, I just think that we, as Americans and as citizens of this world, right,
Yeah.
we don't deal well with rapid rates of change in a short period of time.
Yeah.
So you've had huge spikes of both the cost of the housing and the interest rates, which determine largely the affordability or the monthly payments of housing. And it's something that is so emotional to all of us that it's a recipe for feeling either the pinch because you have a home or feeling left out, like you will never get a home. And we know that housing is um, one of the assets that has the least barrier to entry, right? Because there are great financing and there's great opportunities for first-time home buyers, and many people just don't know about it. But in reality, the reason why we are hurting so bad right now is because home values and interest rates both went up at unprecedented levels in the shortest period of time. If we take a step back, which this data helps us do that, and understand that as a generalization, we are at about, call it 30%, which historically is
The benchmark that we talk about.
is an okay benchmark.
Yeah.
I mean, when we rent a home, we require 3 times the monthly rent to be able to rent a home out. That's, a third the rent, the mortgage payment or the rent payment's about a third of that. So 33%. You can kind of see we're sort of around there, that the affordability has gotten better largely because interest rates have dropped about 0.5%.
Yeah.
And you can see now that if we continue to see some 0.5 point drops on interest rates as we go forward, this affordability crisis that we have is going to get better.
Will no longer be a crisis, right? Like
Right.
if we're like right in line with historical benchmarks, if those numbers are going to like continue to be in favor of affordability, then probably the word crisis is likely to go away as well.
Yep.
Although I'm sure the news will find something to talk about. MVP Lee Bishop says most people purchasing their home are buying with their heart and not like us, not your average investors who purchase with our minds. I think it bears to say that home purchases for owner occupants, right, for people that are going to live in it, is a very different calculation than what we are talking about. And therefore, this is wrapped up with a bunch of emotion as well.
Which is why, as interest rates come down and the heart that you are looking at this home that you love, you have fallen in love with, all of a sudden you can afford it because interest rates have come down, is why, home values are likely to go up.
And Mystery Man Denny Davis puts here in the Q&A, happy Thanksgiving, gents. Putting 2 and 2 together, Greg. I guess he's talking to you only. That's fine, Denny. I'm here too. It seems that the house purchase costs are destined to increase in Jacksonville due to the unprecedented economic opportunities coming into play in the years ahead. Downtown, Fortune 500 companies, UF campus, etc. That will drive average wages higher. Correct thesis? Happy Thanksgiving.
Denny, you are landing the plane very, very well there. And so if I'm taking the Jacksonville lens, what I try to do is to not think about all of those great things that Denny just said, which are absolutely relevant and should drive future home price appreciation. But I tried to say, just put those on the sideline. I even tried to take the exciting things about the Jacksonville market on the sideline and say, listen, if all that happened was what happened for the entire US over the next 10 years since 1982, if that just happened here in 2025, how would we fare? So, Denny, you are 100% right. You can take what I'm about to show you and sprinkle a little bit more home price appreciation because of the Jacksonville market and whatnot. But but here I'm trying to really just take it more generalized and show how things do go up in value even after times that have been deemed unaffordable or a low affordability level.
Got it. Yeah. So I'm sharing that data here. Do you see you want to talk us through it?
Yeah. So from 1982 to 1992. So as I was putting this data together, and Courtney, who's my assistant, was putting this data together, she did a great job with this. I said, okay, well, what did home values do in those next 10 years? And wouldn't you know that home values across the U.S. appreciated about 65%, comes out to a compound annual growth rate of about 5.16% per year, which is higher than the national average, what we know it to be today.
What's the national average known to be today?
4.6%.
4.6, yeah.
So now we didn't know that at that time. It was 1982. That was the date that we were starting to get some of this great data. But if you had known that, right, what this is showing you is that we had most likely higher than normal home price appreciation coming out of those periods where we had low affordability. That was largely driven by interest rate decreases
Got
in the early 80s and then continued through the late 80s and into the early 90s. But your asset grew in value. 1982 was worth for 59,800. 10 years later, 98,800. So total home price appreciation of about $39,000 there. Making the connection to now.
Yep.
Okay. Nobody would have believed 10 years ago or 20 years ago that our home values are what they are today. It is shocking. People would say, I remember when I would buy properties for $100,000 and people would say, I can't believe you're paying $100,000 for that property in Jacksonville. And I was like, I know how home price appreciation works. I know how this works over the long haul for a consistent asset like this. And people are still surprised today to understand that their home values have grown so much over the last 10 years. And, guys, we're going to have the same conversation 10 years from now. So even in a market that was deemed unaffordable in 1982, home values grew at a rate that was higher than what we know the average to be. Coming into this period of where we have felt unaffordability as far as a crisis here, the other side of this is that as interest rates come down, home sales go up, home values go up, and we've seen this cycle repeated many, many times.
If I'm hearing what you're saying, GC, I hear we've been through this before. Single family homes is still a safe place to invest because we expect this to just be part of the normal cycle of stuff that happens. Our wages are in line with our home prices. Affordability this is not the least affordable period ever. And during the least affordable period ever, afterwards, everything normalized and we had higher than average home price appreciation.
Yeah. And you still had home prices going up in 1982.
Yeah.
Just like we still have home prices that are going up here. So we need to think about this affordability as being temporary. We need to think about what's on the other side of that. And we need to make good decisions about where to put our money there.
Good take, buddy. Now,
what you got?
I like it.
What you got?
Oh, I'm setting you up for mine because I'm really excited. So first of all, I'm really excited for my take. I don't want anybody to expect me to be as good on PowerPoint as Greg is. Mine is a very raw PowerPoint of just like numbers on a sheet. But as you know, GC, I've been going to a bunch of different property management conferences. And there's this one guy that every time he speaks, everybody talks about how smart he is. And all these property managers walk away thinking, I got to invest in properties. And this is my buddy, who I've become good friends with, Justin Anderson, wrote this book called Funny Money. So I had him on my other podcast recently, and he literally, right before coming on the podcast, is like, I would like for you to read the book before. This is like, I'm having him on a Monday. He's like, oh God, all right, cool. I want to impress this dude, right? I want to be friends with him. So I literally read this book cover to cover a couple weeks ago on a Saturday, which is mind blowing because I have extreme ADD.
Yeah.
But in it, he talks about a couple of different lenses of how to look at real estate investing. And one that really stuck out to me is like where you find value, right? Like we kept on talking about home values and whatnot. I think if you're thinking about investing, we never think about it in a vacuum. We're thinking about kind of like, where is it better than in other places to invest? And that is like how you create relative value. So the first thing, and he does it with like really good storytelling about his mentor talking to him about like, what's money? What does money mean? And what is money? And all these kinds of things. And he talks about that period in the 70s where Nixon took us off the gold standard. You're pretty good at explaining this. What happened where did we go from to when we decided to like temporarily move off of the gold standard?
Well, the gold standard prevented us from distorting our currency by printing money whenever we decided we wanted to print money, whether that was to fund certain things for our government to be able to do, or whether that was saving us in a crisis time or certain policies or whatnot. Right now, we have the ability to print whenever our leaders say, hey, we're going to print. We didn't used to be able to do that. Everything was on the gold standard at that time. So it was a big deal as we were taken off the gold standard, which it just changed the game. It changed everything about money, currency, investments. It's like before the gold standard and now.
Yeah. I guess the way that he explained it in the book is before, when we were on the gold standard, at any moment, people like it's like you're sitting around a poker table at any moment, anybody could call your hand and you had to like show all your gold, right? Like, and all your currency had to be like backed up by gold. Nixon, I guess, was like, hey, you know what? Temporarily, we're going to just suspend that. We're going to play with these chips. These chips are going to be worth whatever we want it to be worth, right? And we've never gone back to it, right? So like, and I think early on there was like a little bit of like messing around with that, and as time has gone on, we've gotten used to it, and now we can ramp it up and down.
Yeah.
So what has that done? That has made it so that if we are just looking at pricing in dollars, the value of the dollar now goes way up and way down based on like very, I don't know, ethereal things, right? Like we can just print out an extra $2,000 of like bonus for everybody in America, which we did in COVID. We're talking about doing it again today, right? Like our ability to inject money into standards. So Justin in his book argues, hey, why don't we instead of looking at the value of homes in dollars, why don't we look at the value of homes in gold, right?
Interesting.
So he does an analysis here in the book. I've done my own here. I'm gonna, I'm gonna just kind of like show this idea of like gold price housing, this thing that I borrowed from him, right? So he basically talks about like the gold housing ratio, right? Essentially, how many ounces of gold would you have paid for the median home price in different periods in history, right? So a low ratio means that you would have paid few ounces of gold, fewer ounces of gold for a home. That means that there's value in this idea that like home prices are like at a discount.
It's a time to buy.
It's a time to buy.
Yeah.
And high ratio, meaning homes cost more ounces of gold, is a moment where like homes are more expensive, right? So instead of thinking, well, it was worth $100,000 back in this day and $500,000 in this day, we're normalizing to ounces of gold. So he breaks down a couple different periods, right? So one is these like late 70s where the world was moving towards housing as like the ultimate inflation hedge.
Cool.
And at the time, so it was very popular to buy homes, right? Like at the time though, gold was at a low price, and the amount of gold in ounces to buy the median home price was between 1,000 to 1,200 ounces, right? So what happened at that point, rates spiked right after. We went into this period that you're talking about in the early 80s, when periods went up. And if you were talking about timing the market, it wouldn't have been a particularly good time to buy real estate, right? What happens immediately after this period that you're talking about? There's a panic, there's a recession, there's high rates, nobody's buying homes, everybody's running to gold. The price of gold goes up, the prices of homes don't go up, right? And all of a sudden, homes are worth 200 to 220 ounces during that time. And what happened after that? What you just talked about.
Homes went up.
There was a long expansion of home prices going up, right? So this is your period in ounces of gold. Now let's talk about the early 90s and early 2000, right? There was all this like early 90s stagnation that was happening. The gold ratio in the early 90s was 350 to 420, right? Like the ounces of gold. By 2001, the price of a home in gold ounces was 220 to 250 ounces, right? What happened from 2001 to 2006? Super high run up.
Yeah, of course. Yeah. Sorry, I was just you caught me. I was just gonna start to look at my note there. You got me.
I know. Start looking at you. What would you want to see in your notes there, bud?
Nothing, man. Just keep going.
Okay. Yeah. Cool. So I'm just telling the story here, right? So like 2001, it was super low ounces of gold to buy a house, and then we know that there was a big run up to 2006. 2006. What were you doing in 2006, GC?
I mean, I was I was buying as much as I possibly can at that time. And so I quit my job. I was trying to figure out this real estate thing, and I put all of my money, all my family's little money that we had into rental properties.
Yeah. All their money. And you weren't the only one. Everybody was doing it at the
100%.
time. I remember wanting to quit my job. I remember being at a poker table in Vegas. This dude in Utah was like, yeah, man, I'll just teach you to buy houses. Quit your job. You can do this, right? 2006. Gold ratio at the time was 550 to 650 ounces to buy a house. And what happens immediately thereafter? Home prices crash, right? And then I remember that time from like 2006 to like around like I remember hearing, oh, are we at the bottom of the market? Are we at the bottom of the market? Like what are we doing, right? I never heard anybody comparing it to the gold
Right.
standard.
Me either.
I just heard realtors being like, we're at the bottom, everything's gonna be fine every
Yeah.
day,
Right.
right? But what happens? 2012, historically good time to buy homes, right?
Mhm.
Everybody that started buying homes with you in 2012, they're
Did quite
doing
well.
they're doing pretty good,
Yeah.
right? Like the Pac-Man looks insane.
Yeah. Right.
Right. At that moment, 2012, we hit like an all-time low in the price of homes per gold. It was about 140 to 180 ounces. And what happened 10 years after that? Stuff appreciated for a
Mhm.
really, really long time.
Mhm.
And then fast forward to COVID, right?
Mhm.
Like in COVID, still fastest modern appreciation happens.
Mhm.
Price of homes still super low in gold.
Mhm.
Everybody was freaking out. And what happened after that? Super high appreciation rate
Right.
for the years after until end of 2021, 2022. We're back up to this like 450, 500. Yes, it coincided with interest rates going up, but look what also it coincided with, right?
Mhm.
This idea that everybody had been buying, gold was now at a real low, prices were really high, and now we've had this slowdown over time. So, do you want to guess where we're at right now?
I think I saw your notes before. Was it like 200 or 250?
Oh, well, this is just a recap, right? Like these
Yeah.
euphoric peaks that we consider low entry points, high pricing, euphoric, like fearful lows,
Mm.
really, really good pricing. Right now, if we're gonna look at this rhyme, we are near these 45-year lows
Yeah.
in the price of home in ounces of gold.
Yep.
Right. So I don't know,
So-
man. I read this chapter. I'll show it again, right? Justin Anderson, Funny Money. You can pick it up on Amazon. There's a whole bunch of other stuff in here that makes me feel really good about being a Jacksonville rental property investor.
Yeah.
This idea of, hey, let's compare, value to the price of gold versus to the dollars out
Mhm.
there. It feels almost like MOI to me, right? Like it feels like it's not the only thing that matters, but it feels like a really, really significant figure of, we talked about recently that gold hit an all-time high while the stock market hit an all-time high.
Right.
What does it mean? Now I'm thinking, oh crap, gold hit an all-time high. Prices in real estate have stayed stable, have not grown very fast.
Mhm.
That must mean that this is happening, and the numbers show it.
Yeah. Did he talk about like the effect, like the lagging effect? So like gold is an indicator that people are looking for a store of value. And then real estate takes a long, but you can press a button and invest in a ton of gold
Yeah.
right now today. So like the market can react very quickly and run to gold if we
Yeah.
want to. And so the price of gold can go up significantly because of the market dynamics. In real estate, it takes a long time,
Yep.
right? And so it talked about, and I was just doing some research before this, and it's not a fully baked thought, but it was just talking about like, if you think about it, gold or the rush to gold is kind of a harbinger to like how real estate might perform, because the reason that people rush to gold also largely drive people to real estate as well.
Which
It's just
is inflation hedging,
Exactly.
right? Like monetary policy going bananas,
yes,
right?
exactly.
Yeah.
And so it takes some time for that to work through the economy. And it talked about other times. That's what I was looking at in my notes. The other times where this really happened, it was talking about this cycle using the gold standard, or the gold to housing ratio as like hey, this is happening. Gold shows what's going to happen here, and then real estate lags and follows. I don't know. Maybe I'll
I mean, Denny's bringing up a good point, right? He's saying one of the most original takes I've heard in a long time. Agreed, Denny. I loved it. Like Justin talks about kind of like the lens of like property cycle, neighborhood cycle, market cycle, and then he layers this in.
Mhm.
And I think all this stuff bodes very well for, like where Jacksonville is,
Yeah.
these days. Very original take. He's saying only concern is the recent run up in gold. If gold comes crashing back down, the ratio changes fast. But I like the lens you're putting on it, right? Like it feels like gold might be the leading indicator of people running away. They both share this idea of inflation hedging,
Mhm.
right? And then gold also shares this idea of I'm scared, like economic uncertainty,
Mhm.
right? And I feel like housing gets lumped in with economic uncertainty,
Mhm.
when in reality, maybe housing should be decoupled from economic uncertainty and put on the side of like the gold piece. And then gold, much more volatile, right? Because it's much more liquid. So like as people are like running there because they're escaping economic uncertainty and wanting to like hedge against inflation, they go there, and then eventually, real estate is going to follow, because by the time gold comes back down, that means that people are feeling really good about the economy too, no?
Yeah, I think I'd like to understand it more. This is kind of the first time that I'm hearing about it. But if you think about, as gold is a hedge against inflation, and so when people are feeling that things are inflationary, they run to gold. People feel like things are inflationary when rates drop.
Yep.
Because there's more money in the economy. So
Yep.
inflationary, run to gold. Well, that also happens in real estate as well, right? When rates drop, prices inflate. It just takes a long time. So I think there's something there. I think it'd be really interesting to see this like played out over time, and like what did real estate values do in the next 5 to 10 years after this. It doesn't take 5 to 10 years for it to work through the economy, but there's something there. I think that the mystery man's onto something too. I put into ChatGPT as I was prepping for this. I was like, what's the alternative theory to this? Like, how does this not work? And there has been a recent rush to gold, and it talked about how like gold is less volatile than currency, which is why it is a good metric, but it's not infallible. Yep. And the reasons that people are rushing to gold today are much different than why people were rushing to gold, 30 years ago, 40 years ago. A lot of those reasons are the same: store of value, hedge against inflation, those things. But there's other big things. People are rushing to gold because of wars that we have today. Yep. And, countries are trying to get away from bonds more, and they're taking more gold reserves today. So they're getting away from like dollars to get into more gold, because they're concerned about those dollars being devalued because of our inflationary policies. And that's happening at a much greater scale. So it talked about how there might be some of the rush to gold might be not comparing apples to apples to how it would have been in the past. And you could lead yourself to a conclusion that maybe the gold to housing ratio, maybe the standard today of what a good time to buy is slightly different today than what it was in the past. But to me, it just seems like when you brought this up, I was like, man, this is the closest way that we probably have to getting back to the gold standard, or in essence, objectively looking at asset values for what they are and not distorting them based on prices.
Comparing values across asset classes based on gold to value, right? Which for housing, for the market, whatever, right?
Yeah.
Makes sense to me. I wonder who's going to do the first ever like Bitcoin to gold comparison, right? Like that would be interesting as well.
Yeah.
Right.
I don't know. I feel like my mind's expanding as I'm listening about this topic.
Like I've just kind of like long argued that Bitcoin to me is much more like a category king tech stock than it is a store of value gold. Like people say it's the gold. I think it's like the Apple or the Nvidia, right? Like it's kind of doing the same thing Nvidia's doing right now.
Yeah.
Right.
Yeah.
So I think this like, let's find a better anchor that isn't dollar bills, y'all, to like how we price things.
Yeah.
And gold may not be perfect, but you know what? It's been around behaving the same way longer than everything else.
Yeah.
So maybe there's something there.
I mean, and he talked about those like 4 or 5 historical examples of like historically great times to load up on hard assets like real estate.
Yeah.
It has really worked well since in those 4 or 5 times, and they go back to the 1980s. So I think there's something here for sure. And if we go back to the original or the first thing that I was sharing, we need to get beyond people saying, hey, housing can't go up because it's already gone up so much.
Correct.
Like we got to get beyond that. There has to be a real reason to believe that housing would not go up so much. This gold standard is one way to say, hey, if this was $1,000 an ounce or $1,000 an ounce again for the gold to housing standard, that's a real thing that I could look at and be like, oh, you know what? There's something going on here that does not take currency distortion into effect.
I mean, that's why I like to compare it to MOI, right? Like it feels like an original stat that you can look at that gives you like a more fair snapshot of
Yeah.
like where are you in historical relationship
Yeah.
to other things. Patron Santorio's killing it in the chat over here saying you can't rent your gold out and depreciate it, and you can't turn 31 your gold for other gold.
There you go. There we go. We can do another show on, well, we probably can't
We
compare
probably
gold,
can. We
compare
probably
gold
can.
to real estate, but good ideas.
Yeah, yeah. All dude BJ McKay says stated income was like gold, especially if self-employed. When will it return? What does that even mean? Is it that stated income used to be like something that you could self-report and it would I'm not sure what that means.
So stated income was a type of loan where you basically could just tell the bank what you made and they never asked for any pay stubs. So you could pretty much get a loan for, I mean, it was crazy. That's what led to the Great Recession. So stated income loans were a thing. So he's saying that was like gold, especially if you were self-employed, well, will it return? He was just saying that was an awesome way to get leverage. Not necessarily saying it's like the gold to housing ratio. He's just saying those are some good times. And for people who understood how to use leverage, we did quite well. And unfortunately, there were many who did not know how to use leverage well. And there were some negatives to that.
I heard. MVP Lee says, what is Greg's opinion on the 50-year mortgage being proposed? Japan has a 100-year mortgage. Should we do a show on that?
We certainly could. We certainly could. It's interesting because you got to look at this from a number of different lenses. I'll just go with my first gut, which is if you told me that I could borrow money for the next 50 years at a 5 or a 6% rate or 7%, I don't care what it is. If you told me I could do that, like I would load up as much as I possibly could, and I would build generational wealth beyond my next generations, and I would just hold as many assets, hard assets as I could. I mean, it would be such an opportunity for investors who understand that when you are paying that loan back in 40 or 50 years, you're paying it in devalued dollars. So this whole show that we've been talking about has, been showing about how currency has been distorted because of our inflationary policies where we print money.
Yeah.
If we continue to do anything like we have done as a country since we got off the gold standard, the ability for us to buy and have mortgages for 50 years is like the greatest generational wealth building opportunity for those who know how to use it. For those who it would likely lead to a society more of those of haves and have-nots, though, because there's not a lot of access. Not everybody has access or understanding to be able to see how a 50-year mortgage is a incredible wealth building tool for you. So if I kept the investor lens, if you gave me the opportunity to take 50-year mortgages and put them on things like single-family rental properties, which is a critical need, which is a consistent performer, which pays for itself every single month, I'd be in that all day, every day, and twice on Sunday.
Yeah.
I don't know how that would work for everybody at large because I worry about an economy and a society of haves and have-nots, and I think that would probably, lead to more towards that.
I hear you saying a 50-year mortgage would be a powerful tool for financial engineers, and with great power comes great responsibility, right? Like we don't know the outlier effects that would happen. It's kind of like creating these like moments where people can, get too much debt on or stuff like that. Like we've gotten the hand burned on the stove before, so we don't know how that would work. So there's like a lot of details in there.
Yes, but I just think that like in addition to that, like we have our 30-year mortgage right now, which is by far and away like the best mortgage that you get from any country in the world. There's only like a small handful of countries out there that can even offer a 30-year mortgage. So we do so much to incentivize the housing market by how we operate as a country that I wonder if, do we really need a 40? Do we really need a 50?
That's true. No other country in the world are there like, whoa, you can indebt yourself like this.
Yeah.
Like we're already the outlier amongst outliers.
Yeah.
And being able to do that.
Which from the lens of how we operate, if once we fully understand how beautiful the 30-year mortgage is for everybody, and then we educate ourselves and surround ourselves with others who also understand it's like this is the greatest wealth building tool to be able to borrow money for 30 years at a 5, 6, 7% interest rate. It's the greatest thing that you can do as an individual investor, in my opinion, is to learn how to master that smart debt. The downside is that as more assets are owned by fewer people,
Yeah.
Those who don't have the education or the ability to get those, economies in society can suffer overall because of the haves and have-nots. So.
Yeah, haves and have-nots. It's definitely a subject that is becoming more and more prevalent in the American kind of fabric, right? Like,
yeah,
it's interesting times we're living in, man. I like this format of like you come up with one thing, I come up with another thing.
Sweet.
What do you think?
I love it, man. I thought your topic was awesome. And it's cool how both of our topics really related to each other.
Yeah. That was, as I was like reading this and I knew that you were coming on, I'm like, oh, look at that.
Yeah.
1982. Like, this is,
How about that?
This is a moment where it overlaps.
You think I could borrow that book, buddy?
You want to borrow this book?
I do want to borrow that book.
This book.
It's
Officially borrowed it. Officially borrowed it. Funny Money by Justin Anderson. Let him know that I sent you. Awesome guy. Lives in Augusta, Georgia. Maybe we can go play golf.
Ooh, I love it.
Yeah, no big deal. What do we got next week? What's going on later this week? Thanksgiving, GC? Plans?
Yeah, man. Super pumped. We have some Thanksgiving traditions. We do a little 5K in our community. We have some friends over, family times. I mean, all those good things. Couldn't be more excited about Thanksgiving, the holiday season. I got my trip planned for Christmas. All that good stuff. Things are good, man. How about you?
I'm going down to Miami to see my folks because normally we go to North Carolina, but this time it's Miami because my goddaughter's bridal shower is going to be on Saturday, and I'm also taking my dog Miss Piggy down to meet her grandparents.
Is Piggy fired up?
Piggy's fired up on everything.
She is.
As you know, super excited, man. Anything that you've been thinking about that you are grateful for these days?
We did this exercise in TMM this morning, and we sat in small groups and talked about what we were grateful for. And I'm really grateful for this team. I'm grateful for like the place that I'm at. Within JWB, I'm grateful for being here. I'm just grateful for my ability to be here with people that I love, that support me, and to also have a platform to serve others. I think this year, more than probably any year, I've just really understood that service is at the core of kind of who I am, and I'm happiest when I serve. So I'm super grateful that we have this collection of people here in the community. We have this collection of incredible people here on the team, and that we collectively get to serve and really change the lives of tens of thousands of people.
That's awesome, man.
Yeah.
I feel like we are in scary times in the world right now. And I think you and I, maybe you're a little younger, so I don't know if you remember, but I think we've gone through, like a couple of periods of like real economic uncertainty during our career. This is the first time that I feel in a period of economic uncertainty and established financially and professionally enough to not really be worried about it for myself, but to be able to be one of those folks that can like see through the fear and see through all these different things and I don't know, play a little bit of offense, right? Like during this time. And I'm just really, really grateful for it, right? Like the feeling I had in the economic recession was very different. The feeling I had at the beginning of COVID was very, very different. And right now, although I am very worried for my fellow Americans and like what the world is going through, I'm also, Marta and I are just like personally feeling very safe financially and where we are, man. So I'm really grateful to feel that way. And I don't think I would have gotten there without this experience.
Yeah. Well, I mean, you have done a lot to set yourself and your family up to be able to deal with uncertain times and to be able to act with calmness, confidence. So you guys should feel really good about what you've done for yourself.
Cool, man. Love it. Speaking of that, our buying incentives, builder incentives that we talked about last week, is that still going to be going on this month?
Yeah. We have cash flow credits that are available. And so those cash flow credits can be applied. And that's how you're getting positive cash flow today and winding up with, a majority of your, reserves for your properties already built in. They can be upwards of $10,000 to maybe $13,000 per property. So if you're interested, reach out to the sales team or to your portfolio manager. And it's a great time.
Let me see if I got the slide here that shows all the places to connect with JWB. I don't think we have it in one of these recent slides. Anyways, go to chatwithjwb.com if you want to set up an appointment with JWB to like go down this path. 904-677-6777 if you want to give them a call. I can't remember the text number. I'm sorry.
904-293-0341. 904-293-0341.
Yeah. Should this stuff be available through the end of December, you think?
Yeah, I can't tell you how long they're going to be available. Think about this is the way that these cash flow credits are priced in. We have to determine, we have to hit a certain rate of return. And so while interest rates are still elevated from what we all want, those cash flow credits are there to make sure that we can deliver that rate of return, both a cash on cash return year one and also your long-term return on investment. So that's just what the market requires. So those incentives, while they might be $10,000 or $13,000 today, if interest rates come down, they might be $5,000 next month. Either way, you should get comfortable about buying an asset that hits a couple $100 a month of cash flow and a 5% cash on cash return and 10 or 11 or so internal rate of return. Those things are what will be here regardless of what interest rates do and whatever incentive or cash flow credits are.
Got it. All right, cool. Ringmaster Drew says, any more news on the summit?
Yeah, I mean, we just had we had a great meeting yesterday. Pablo and myself, we got with the team, just shared our vision of what we thought would be really cool to, I think, bring to Summit this year. So lots going on in the background here. The important things for you to know is that the Summit date is confirmed. It's February 19th to the 21st. You're going to want to make February 18th a travel day and probably plan to leave on the 22nd. So it used to be a 2-day event. There is a 3-day event now. So it's going to be really, really incredible. We're working on exactly when we're going to open up tickets. We don't have a date for when we're going to open up for the purchase of tickets, but we will certainly let you know, and you'll be able to buy them first here being on the show. We'll give you a little bit of time as far as a little bit of a heads up, but keep tuning in. We know it's going to sell out just like it has every year. We are going to keep it limited again as far as it just being JWB clients. And it's going to be awesome. So we can't wait.
Lee says he will be there wearing his hat.
Nice. Nice. I can't wait.
I love it. I love it. Mike Fox asking cost of tickets, probably around the same as last year. We haven't really figured that stuff out, but the important thing is the dates are locked. So if you want to book your travel and you want to like have that done, it's going to be similar to last year's experience, a little bit better. We're getting better at doing this, I think. So it's going to be really, really awesome. And what's the show next week, GC? I usually have that pulled up here, and I don't really remember what it's going to be here.
I just rely on you for that.
Yeah, I'm letting everybody know. Number one government policy to watch for investors.
Oh, cool.
And spoiler alert, it is not interest rate.
Yeah.
That's what we're talking about on Tuesday. Hope to see you there. Of course, have a happy Thanksgiving. Of course, one of the things we're really, really grateful is you, our community that shows up to these shows. This would not exist without you, asking these great questions, connecting with each other, tons of love in the chat here. And I just see a bunch of names that I'm pretty sure I'm going to be seeing on February 18th.
I love it. I can't wait.
Yeah. So thank you. Thank you for everything. I hope you have a happy Thanksgiving with your family. Hope to see you next week. Any advice until then, GC?
Happy Thanksgiving and don't